The RBA's decision will be primarily focused on inflation. That's their primary target. And at the moment, I think inflation is still too high, running around 6% over the last year. That's the key consideration for them, whether or not to hike the cash rate. Secondary to that is obviously the labour market and whether employment is at a level that they deem full employment. And at 3.5% unemployment rate, at the moment, the economy is operating at a level that is beyond what they would call full employment or NAIRU.
Clearly, the inflation figures are key for the RBA. Inflation has been coming down in Australia over the past couple of months, and we did see a relatively low inflation print for the June quarter. That's an overriding reason why we think the Reserve Bank will pause tomorrow. But clearly inflation as well as the labour market are key for the Reserve Bank's deliberations tomorrow.
I think the RBA most likely will raise the cash rate by 25 basis points. The RBA is now a close call between holding or hiking because in the last week we have seen some softer data than expected. Inflation was below the RBA's forecasts, and also we're seeing consumer spending measured as retail sales also decline in the last month. So there is a case for the RBA to hold rates for now, but the more likely path is they'll continue to just have one final hike of 25 basis points.
We think the Reserve Bank will hold and keep interest rates at 4.1%. Inflation has been falling in Australia. We think it's fallen enough that the Reserve Bank can now pause and not push through a further interest rate increase in August or beyond.
One single rate rise by the RBA doesn't resolve the problem Australia has, which is inflation still too high and has been so for a couple of years. Even looking ahead, the lagged impact of prior rate rises will help to ease demand and over time moderate the inflation pressure in the economy. But it's really about the cumulative tightening of monetary policy that's occurred over the last year or so. The RBA took the cash rate down towards zero during COVID, and it's been a relatively rapid increase in the past year or so. But we're starting to see signs now in consumer spending and the general outlook for the economy with inflation starting to come down that the prior impact of lagged rate rises is starting to work. So I think there's now going to be scope after this next rate increase for the RBA to sit pat and hold rates for a sustained period of time.
Because inflation has predominantly been driven in Australia by supply-side pressures rather than demand-side pressures, increases in interest rates have mostly been ineffective at bringing down inflation. The most prominent supply-side factor in the last 12 to 18 months has been international supply chain congestion, as well as the cost of the war in Ukraine. What we're now seeing is those supply-side factors shift to domestic factors like the housing market. In none of those instances will higher interest rates help to bring inflation down.
It's not absolutely inevitable that unemployment does have to go up enough to cause people to lose jobs to get inflation down, but that is the more likely scenario because what we've seen globally is that inflation's been relatively sticky in this cycle compared with the last few decades. So you've seen inflation rates come down from the peaks in the middle of last year, in some countries towards even 10%, but they're relatively sticky compared to what central banks want to achieve, which is inflation around 2 to 3% in Australia, or in other major economies even lower than that. So the problem the RBA has now is that they can get inflation down, but the difficulty of getting it all the way back down to target without causing unemployment is something they haven't had to navigate before, this so-called narrow path to a soft landing. So I think the more likely path from here is the RBA would like to slow growth moderately but not cause a recession, and that means that the unemployment rate ticks up slowly over time, but you don't require mass job losses to get inflation down.
Traditionally, what we think about in terms of inflation is too much spending in the economy. So very low unemployment, high wage growth, lots of spending, and the need for the Reserve Bank to increase interest rates to temper demand in the economy and to bring down inflation. And when that happens, inevitably unemployment does rise. What we're seeing at the moment is inflation driven from a particularly different source, not demand side but supply side pressures. So in that particular instance, it's not necessary that unemployment does need to tick up such that wage growth softens. We haven't seen significant wage growth in Australia. It's not a key driver of inflation. Therefore, it isn't really necessary for unemployment to tick up in order to get inflation under control.
I think the RBA is getting close to the point where policy is so-called restrictive enough to tighten up financial conditions in the economy, to take away the cash flow to get inflation down. I think there's an argument about whether or not they've gone too far, but that will only be evident with hindsight over the next year or so. I think it's more likely, given the resilience of the global economy to prior rate rises, that the RBA will feel comfortable that they actually do have to do a little bit more just to ensure that their inflation outlook is consistent with their mandate, which is to get it back down towards that 3% level over the next year or so.
In our view, the Reserve Bank has already done too much. The 400 basis points of increases that we've seen since May are still to work through the system, and so some of the decisions that the RBA has already made will continue to flow through. That will be exacerbated by the fact that there are still quite a large number of households shifting from fixed to variable mortgage interest rates. But more to the point, the Reserve Bank's own research shows that most of the inflation challenge in Australia is driven by supply-side factors. In that context, the Reserve Bank has certainly done enough to dampen demand-side pressures, and the residual supply-side driven inflation needs to be tackled by other policy measures, not the Reserve Bank's interest rates.
The Australian economy has been relatively resilient compared to what a lot of people expected a year ago, despite 4 percentage point increase in interest rates from the RBA. But from here, you are seeing the lagged impact of those prior rate rises because many households had fixed mortgage rates, and as they expired, they're going to have a sudden large increase in required repayments, which will really crimp their cash flow. So from here, I would expect the economy to continue to weaken quite sharply, with real GDP growth slowing to the lowest level in several years, probably even under 1% year on year. But it's not quite a technical recession. I would ascribe a 25% probability to that happening. If the RBA had to raise rates multiple times from here and continue to move further into restrictive territory, then the probability that recession becomes a 50-50 call.
We see the Australian economy as relatively weak at present. We've seen very slow growth in the first quarter. We now see declining retail sales in nominal terms. We think in volume terms, that data out later this week retail sales will have gone backwards in the June quarter, consumption likely to have gone backwards in the June quarter, dwelling investment also struggling. So this is an economy that is growing very sluggishly. On an overall picture, though, we don't expect a recession over the coming quarters, but the only real reason for that is very high rates of population growth. So on a per-person basis, the economy is absolutely going backwards, and we expect a per capita recession, a per-person recession of 0.5% this calendar year and next calendar year.